Now, let's take a made-up example called Gizmo, right? Gizmo create a holding company, either resident here but non-resident for tax purposes as per your example, or resident in the Caribbean. And then we have Gizmo Operating Company. And Gizmo Operating Company makes €2 billion in revenue in a given year and has operating costs of €1 billion. And therefore, a pre-tax profit of €1 billion. But it also pays €1 billion to Gizmo Holding in royalties for whatever, the brand, whatever it is, right? So we have Gizmo Operating Company attracting €2 billion in revenue, €1 billion in operating costs, and paying zero corporation tax. But that, if I understand correctly, that sort of tax avoidance is not included, couldn't conceivably be concluded in the effective rate which we as parliamentarians are told of somewhere between 11 and 12%. Would you agree with that?
It sounds right to me, yeah.
Okay, and therefore I think this is...
The difference between the 12.5 and the 11 here, as far as I understand, is probably primarily in the R&D allowances, you know, that there's very generous R&D allowances. Now, you're right, that's actually under investigation by the revenue to the extent that they may be being exploited. But I think that's the primary difference between the 12.5 and the 11, is that certain expenditures on R&D are, you know, you get
sure.
big tax benefits for it.
So this is why I've always struggled with these corporation tax effective rates. Because what we're saying is, look, there's in and around 50 million which goes back to companies for proper R&D activity, let's hope, right? Yeah. By the way, there are tens of billions of euro being made here, which are almost entirely being funneled out of the country or just not being paid anywhere. And when we figure out our corporation tax, we ignore all of that. So I guess I would like your opinion. Is it reasonable of me to say that our effective rate is 11.1%, ignoring all the tax avoidance that goes on?
Yeah.
Right.
Yeah.
So that's an interesting effective rate. So the effective rate is 11.1% if we don't include all the tax avoidance. Now, tax avoidance is legal, sure.
Right? Now, the issue arises, of course, yeah. Particularly in America, you know, we have good data on the amount spent on lobbying politicians and so on. So presumably, you know, laws are influenced by, you know, interest groups. No surprise there. But it's actually, and I'd say this might well be a first. It's really the last question that Richard was asking there as well. That the way I think about it. So my cola example that I put to you. Let me use a pharmaceutical company example. So the pharma firms down in Cork, the pharma factories, the stuff that goes in one end is bulk chemicals, which are very cheap. The stuff that comes out at the other end are, you know, these pills that cost $20 or something like that. That doesn't mean that those factory workers are the most productive workers in the world. You know, what the value, the profit there is the profit associated with the fact that this is Pfizer or something like that has spent billions in research and development that ran into the sand, because most, you know, out of every 20 billion you spend on research and development in pharmaceuticals, most of that is wasted and never sees the light of day. So it's not really true to say that all the profits are generated in this factory in Cork, where what comes in is cheap bulk chemicals. What comes out are very valuable products. Yeah. You can't say that's because those Irish workers are spectacularly productive.
Well, just to be clear, I'm not. I'm just establishing a base that says the 11.1% is our effective corporate tax rate, ignoring all of the tax avoidance. That's the first point. The second point, just which is an aside, but to your point,
let me put it my way. The 11.1 is the revenue generated on the base of the profits that are deemed taxable in Ireland minus certain allowances.
But by definition, absolutely.
Yeah,
And the point I'm making, which is conveniently ignored when one talks about effective corporation tax in Ireland, is it is that rate ignoring all the tax avoidance. On a quick aside, because I wouldn't like anybody listening to think that Irish engineers don't add any value. I started off my life actually as an engineer out of UCD, and whilst the science for the compounds for these things may indeed come from China, America, Portugal, Dublin, wherever, there's a huge amount of IP and innovation and value add in high-end manufacturing. When you think of the Intel plants, you think of the HP plants, this is super high-end world-class manufacturing with vast IP and value add from Irish engineers. Just to be clear. And I'm not suggesting that Pfizer don't pay any profits here, or Intel.
I presume you got scientists and engineers in your constituency, do you? Listening carefully.
I have no idea. I've no idea. But I just think that's important because it follows on to the next question, which is what I would like, and I'd love to know if you have seen this analysis, is an analysis of the quantums involved. Because as far as I can tell, there are 4 different types of tax paid and avoided in this country. And I'd like your thoughts as to whether these 4 segments are correct. The first is corporation tax paid here in full, be it at 11.1% or 12.5%. I deem the R&D credits to be perfectly legitimate. So there's segment 1, which is taxes paid here in full. There's segment 2, which is an interesting one, which is actually taxes paid here in full plus more. So this is something we know that the UK are beginning to look at, which is, for example, an advert sold in the UK to a UK company with the advertising in the UK, but there's been an exchange on a server sitting in Dublin, and therefore the profits for that are declared, but they're declared here at 12.5% rather than the UK at 40%. So that's the second segment, actually, where we are gaining from, where companies are paying on revenues here and from abroad. The third segment is transfer pricing. So if we go back to Gizmo, where the holding company may be resident here, the operating company, let's say the operating company pays 500 million in royalties and then declares 500 million in taxes. So corporation tax is paid in here, but not fully. And the royalties wouldn't be included, the royalty transfer would not be included in the effective corporation tax. And then the fourth one, which is taxes which simply aren't paid anywhere, right? So we have Apple have discovered this loophole between the Irish and the American law, whereby they're bringing in, I have the briefing note to the US Senate committee, which said Apple Operations International, which has no employees, has no physical presence, is managed and controlled in the United States, and received $30 billion of income between 2009 and 2012, has paid no corporate income tax to any national government for the past 5 years. Would you be comfortable with, are they, in your opinion, the right 4 segments? Normal tax paid plus a bit, maybe from activity in the UK, part tax paid due to transfer pricing, and no tax paid due to non-residency anywhere, or residency for the holding company in a jurisdiction where there is 0 corporate tax paid?
You can split that pie any way you want. I mean, you could look at it from the viewpoint of the British tax authorities, the Irish tax authorities, global tax authorities. So you could chop it up any way you want. Let me make one point about this, though. That so Apple, as an American company, those profits accumulating wherever, presumably somewhere in the Caribbean, it tends to be the Caribbean. If they're ultimately distributed to Apple shareholders, they have to go back to the US, so that triggers a tax liability. If they're not repatriated to the US, which they would have to be distributed as dividends, then they contribute to the value of the company, right? So they're invested overseas. The value of Apple shares go up. Ultimately, capital gains liability will be triggered on that. So there will be some tax revenues. Now, I'm not saying that this is optimal, not by any means, but ultimately, those profits are accumulated. No matter where they're accumulated, they're going to be reflected in the share price of the company, right? I mean, I guess you probably know more about this than I do, but that's my way of thinking about it. So they either go to shareholders in the form of distributed profits, or they're reflected in share prices, and ultimately, presumably, will trigger capital gains tax. So they don't disappear off into the ether. I think that's right. This is kind of finance.
Thank you for
rather
that.
than my
And
area.
I take your point on the segmentation. Can I ask you, what I'm very interested in is getting the full picture, right? So what we have is numbers around the 11.1% and the figures around the 70 billion and so forth. I can't find any figures that say, by the way, there is X hundreds of billion coming into Ireland and moving out of Ireland in those sort of segments. Do you know of anyone who's done that analysis so that we could get a full picture of the scale of the transfer pricing that's going on?
That's the sort of thing that my colleague Jim Stewart does, even though I wouldn't necessarily stand over the final numbers that he comes out with, but he does analyse those kind of flows through Ireland. Yeah, so the flows out of Ireland we can trace easily through the balance of payments. They tend to go. They're either kind of repatriated profits or royalty payments and so on, which are huge items in the service account of the balance of payments. But the inflows coming in, I'm not sure. I don't know how to trace that. What Jim Stewart does is he looks at individual company accounts and tries to trace those flows. You're probably more interested at the aggregate level, and I'm saying I don't know. Presumably they're reflected somewhere in the balance of payments, but I think it'd be a fair bit of detective work to figure it out precisely. Probably Sean Barrett might
That's
might
why
know
we have
about this stuff.
schools of economics in our universities. Can I ask a final question then, Chair? Thank you, and thank you for those answers, Professor. Are there any actions that you believe we should take unilaterally, or do you believe that our approach should be wholly and exclusively a multilateral approach, which I believe you're saying is the correct approach for us is the OECD approach?
Unilateral actions are sometimes beneficial if we're a step ahead of the game. Nothing completely springs to mind about what we can do to generate extra tax revenue, is really your point there, without possibly suffering detrimental long-term consequences. Again, Richard, I'd make the point to you, as I said to Pierce earlier on, our corporation tax revenues as a share of national income are higher than the average for the OECD and the EU. That may possibly have changed over the course of the recession, but for a decade or more before this current crisis, that was the case. So we're not losing out in terms of corporation tax revenues. We're gaining substantially in terms of jobs, spillover effects, and so on. So it's there's no one silver bullet item that I can come up with and say this is a change that we should be thinking about. They all have, whatever changes have possible short-term benefits, we have to worry about long-term costs.
Great. Thank you very much for your time.
Okay, thanks.